It just snapped. Not slowly, not gradually. The paper silver market crossed a line it cannot uncross, and almost nobody noticed when it happened. No alarms went off, no emergency headlines. Just a quiet moment where the system stopped behaving like a market and started behaving like damage control. And once that happens, there is no rewind button. What you're about to hear is not speculation. It's a breakdown of signals, behavior, and contradictions that only appear when a financial structure hits a point of no return. In the last few days, silver did something it has only done before major dislocations. Price dropped aggressively while physical demand did the opposite. Volumes surged at odd hours, liquidity vanished when it was needed most, and the response from institutions was silence. That combination is rare, and when it appears together, it usually means the real decision-making has already happened behind closed doors. Before we go deeper, if you are here because you want to understand what is happening before it becomes obvious to everyone else, take a second to like this video and subscribe. This channel exists to explain what breaks quietly, the silent collapse publicly, and staying ahead matters more now than ever. Here's the uncomfortable truth most people don't want to face. The silver market you see on your screen is not the silver market that actually exists. It hasn't been for a long time. What you see is a paper price built on contracts, leverage, and promises. What exists in reality is physical silver, and those two worlds are now moving in opposite directions. For decades, this system worked because confidence held it together. As long as most traders never asked for delivery, paper silver could expand endlessly. 1 ounce of physical silver could support hundreds of paper claims. That was never sustainable, but it was profitable. And as long as nobody tested the system all at once, it survived. What changed is stress, real stress. Industrial demand hasn't slowed, mining output hasn't surged, recycling hasn't magically filled the gap. Yet paper supply continues to grow. That imbalance creates pressure, and pressure always finds the weakest point first. That weak point is delivery. Over the last sessions, large sell orders hit the market with surgical precision. Not emotional selling, not retail panic. These were calculated dumps during low liquidity windows, designed to break technical levels, trigger forced selling, and create the illusion of control. This is how you manage perception when reality is slipping. At the same time, physical premiums didn't collapse. In some regions, they rose. That should never happen in a healthy market. When paper prices fall sharply, physical prices should follow. When they don't, it tells you the price is no longer connected to supply. That's when a market snaps. This is the point of no return. Because once participants realize price is no longer a reflection of reality, trust evaporates. And markets without trust don't function. They don't stabilize, they fracture. Look at the behavior of institutions. No reassurance, no transparency, no explanations. Just quiet adjustments, margin changes, contract rollovers, position reductions. These are not signs of confidence. They are signs of preparation. People often misunderstand manipulation. They think it means prices must go down forever. That's wrong. Manipulation is about timing and control. You push prices down when liquidity is thin to force weak hands out. Then you reposition quietly while fear spreads. And fear is spreading, even if it hasn't reached headlines yet. Vault data has become increasingly difficult to interpret. Classifications change. Categories shift. Silver moves from available to registered, then disappears from reports entirely. These are not clerical errors. They are pressure responses. Ask yourself a simple question. If everything was fine, why make reporting harder to understand? The paper silver market is enormous. When you include futures, options, swaps, and derivatives, estimates run into the tens of trillions. The physical market is a fraction of that size. That means the entire structure depends on one assumption. Most people will never demand what they re-owed. That assumption is now being tested. When confidence breaks, systems don't collapse evenly. They break asymmetrically. One side gets trapped. The other exits early. That's what you're seeing now. This is why insiders don't wait for confirmation. They don't need headlines. They watch plumbing, settlement delays, liquidity behavior, counterparty risk. And when those signals turn, they move quietly. Retail investors always see it last. And this is where history matters. Every major financial dislocation followed this exact sequence. First, distortions, then denial, then sudden rule changes, trading halts, cash settlements, emergency measures framed as stability. Silver has been here before, and each time the resolution was not gentle. What makes this moment different is scale. The leverage is larger, the demand is global, and trust in institutions is already fragile. Governments and central banks care deeply about silver, not because of the metal itself, but because of what it represents. Silver is a signal. When silver disconnects from reality, it tells you something is wrong with currency credibility, debt sustainability, and systemic trust. This isn't just about investors. Silver is critical to industry, energy, technology, medicine. When pricing mechanisms break, supply chains feel it next. That's why this snap matters. People keep asking whether silver will crash or explode. That's the wrong question. The real question is whether the paper market can survive another shock without rewriting the rules. And based on what we're seeing, the answer is no. Once a market reaches this stage, outcomes narrow. Either confidence collapses suddenly or access is restricted quietly. Both outcomes hurt those who wait for clarity. The most dangerous phase is the one we're in now, where nothing looks broken enough to act, but everything underneath is strained. This is why silence from institutions is louder than words. If silver was truly stable, reassurance would be easy. Transparency would calm markets. Instead, we see avoidance, and avoidance always precedes exposure. This channel exists to talk about what happens before the headlines catch up. Before it breaks isn't just a name, it's a framework. Watch behavior, not narratives. Follow incentives, not promises. We are not saying silver ends tomorrow. We are saying the paper structure crossed a line it cannot uncross. From here on, volatility increases, trust decreases, and control tightens. That's what point of no return actually means. If you're still watching, you already understand more than most. And I want to know what you think. Do you believe the paper-silver market can still function as it is, or has it already snapped? Drop your thoughts in the comments. Share this video with someone who still believes prices always tell the truth. Because when this finally becomes obvious to everyone, it won't be breaking news. It will be history.